Hi, very good evening, ladies and gentlemen. Thank you for joining me today for this webinar. My name is Simon Teo. I'll be the presenter for today. So the topic that we'll be talking about today will be trading the US indices CFD with technical analysis. All right, just before I begin, just a standard disclaimer that we need to inform the attendees. So for today's session, it's mainly for education purpose. So there's no trading calls or any official views from the company. So if you want to do any trading, please understand that this will be at your own risk. All right. Okay, so the content for today, what we'll be going through for the next 45 minutes or so. The first part will be mainly on the introduction. We'll be discussing about technical analysis. So what exactly is technical analysis? And some of the indicators that I'll be using today to share with you how we can form a strategy using a moving average and a relative strength index. And the part two of the session will be talking about how can we use all these indicators to come up with a strategy to determine the trend for the day, and how do we enter a trade. Okay, how do we do a trade? So basically, the next 45 minutes or so, we'll be going through something like this. All right. So before I begin, usually for my session, I like to have some warm-up questions to ask the audience. If you have been trading for a while, probably you will be hearing people talking about trading. Is it important to have IQ or EQ? All right. So just a quick question. Okay, maybe. All right, sorry. So to be successful in trading, we always hear people say that we need IQ and EQ. So what exactly does this mean? Okay, what exactly does this means? And other than IQ and EQ, right? Is there anything else that we need to be successful in trading? Okay, so maybe you can spend a few minutes just thinking about this. I will not be going through my views right now. Okay, probably at the end of the session, if you stay to the end, I'll just take about 5 minutes to share this view, to share my view on this with you. Okay. Yep. Okay. So part one, introduction. So let's begin with having a discussion about what exactly is a technical analysis. We've been hearing many ways of interpreting the market, some using fundamental analysis, some using technical analysis, and nowadays we are hearing people talking about qualitative analysis. So quantitative analysis, sorry. So what exactly is technical analysis? How does it help us in trading? So my interpretation for technical analysis, right, it's a pattern recognition technique. Okay, what does it recognize? It's we are trying to find repeated patterns in human behavior towards price action. Okay, so technical analysis aims to find repeated patterns in the chart or in the price action. So probably you have heard of many different terms or patterns like when double top or double bottom. These are very common terms that people have been using or talking about. So when people say that, oh, I'm seeing a double top usually is a bearish sign, is a bearish pattern. Why is it so? Because probably in history, right, people have seen this pattern many times, and when it forms a real double top, the market will fall from there. So it has happened many times, and so people find that this is a repeated pattern, and they use it to do trading. Okay, so in technical analysis, we will try to find repeated patterns. So today, what I'll be sharing with you today is some of the patterns that we have found throughout the years that has been repeating. So probably we can use that to see how we can forecast and predict future price actions, and we can use that for trading. Okay, what are the different type of trading style or strategies? This is important, okay, because we need to understand our own style. Our own style can be determined by how much time we can commit in trading. Okay, so for example, the first trading style, we call it scalping. Scalping is a very fast-paced trading action that we do only probably like we enter a trade and exit maybe with a very, very small profit. Okay, maybe 2 to 3 points profit sometimes. So this is a very short term, very, very short term kind of trading style. So for this to be successful, right, traders need to be able to spend time watching the screen. Okay, because we are doing very fast trading, you need to have very fast reactions, and we only take profit very small points. Okay, so scalping is for people who are able to spend their time on the screen all the time when they are trading. So if let's say we can't do that, there's another strategy or another type of trading style that calls intraday trading position trade. These are for traders who probably would like to participate in the trades, but probably no, we can't spend time on the screen at all time. So we can probably just place a trade and check maybe every couple of hours to see whether is it done and where is our take profit target and stop loss, so we can preset everything. This usually is a very, very common, more commonly used by a lot of retail traders, because most of us, we have a job, we have a full-time job, so trading is probably more of a part-time or extra income kind of thing. So we won't be able to spend the time on the screen watching. We just probably want to place in the trade and then and put all the stop loss take profit, and then we check the price every couple of hours or on and off. So today the strategy that I'll be sharing with you, right, will be more on this intraday position trade, right? There's another kind of trading, probably this is really if you are more long term, if you don't like to do so fast trading, right? You want to aim looking at the bigger trend, a longer trend, and you probably hold positions for weeks or even months. Then you can talk about this swing trading. But swing trading, of course, the longer we hold the position in the market, right, the higher the risk and the more volatility we need to endure, right? So swing trader probably is for people who a little bit more like investor kind, okay, and want to take part in the market. So it's a more long-term kind of trading style, right? But today we'll be talking more about the second one, okay, intraday position trade. This is very, very popular among a lot of retail traders. Okay, so let's go into the different kind of indicators that we're using today. So the first one that we'll be using is the moving average. Okay, as the name implied, the moving average simply measures the average price over a specific time. If you have been trading for some time and you've been using charting, right, this is, I'm definitely sure this is not very alien to you. You probably have heard of this thousands of times. The moving average that we'll be using today will be the exponential moving average, or EMA for short. Okay, the exponential moving average is similar is to the moving average, simple moving average, but the formula actually places a greater weightage on the more recent closing prices. So for short-term trading or intraday trading, we want the moving average to react faster to recent prices. So we use the exponential moving average instead of the simple moving average, right? Simple moving average usually is for more a long-term analysis. When we want to find a longer term trend, then probably we can use a simple moving average on a bigger time frame, probably a daily or even a weekly kind of time frame. All right. So for today is the exponential moving average. So how does it look like on the chart? If you have not seen it before, it will look something like this, right? You can see the lines here. So there are two moving averages here. So once we set the time frame, it will appear on the chart and looks like this. Okay, so this is one of the indicators that we'll be using today. The next indicator that we're using today is called the RSI, or the Relative Strength Index. So it's a oscillator. If you can see, right, it's on the bottom of the screen. So the RSI is what we call it, oscillator. What it does is it has two levels. Okay, level 30 and level 70. 30% and 70%, right? So according to the creator of this indicator, right, if the RSI moves below 30, it moves below 30, it's an indication that the market is temporarily oversold. Okay, that means it dropped too fast, oversold. If it's above 70%, then the market is probably overbought, temporarily overbought. All right. So this is how we use the indicator, 30% and 70%. Okay, so this is the creator, and it's oscillate between 0 to 100, but most of the time we use 30% and 70% for oversold and overbought signal. All right, so here you see, okay, 30%. So if it goes below 30%, it's an oversold signal. If it goes over 70%, then it's an overbought signal. All right. So these will be the two indicators that we'll be using today to try to form a strategy, okay, from these indicators. All right. So okay, sorry. Okay, let's go to part 2 of the trading strategy. So part 2, we'll be using the moving average. The first step is to determine the trend for the day. We would like to determine the intraday trend for the day. So how do we do that? We will use 5 sets of moving averages. Okay, 5 sets of moving averages, and the settings are as follows. Okay, you can take your time to take a look. It will be 5, 20, 50, 100, and 200. Okay, applied to close. And usually for the time frame that we use for trading will be 15 minutes or 30 minutes. All right, 15 or 30 minutes. Okay, sorry, too fast. Okay, yeah, so this is how it looks like after we do the settings. And on the chart, you'll see 5 moving average lines. And how do we determine whether it's an uptrend or a downtrend? Very simple. The line here, right, the first one, the pink color line, will be the moving average 5. The second one, the purple one, is 20. The light blue is 50. The dark blue is 100, and the orange will be 200. So if we see a sequence, okay, the smaller moving average above the other in a sequence, 5, 20, 50, 100, 200, that is an indication of a beginning of the uptrend. All right, so I repeat myself. If you see the moving average starting to form a sequence of 5 on top of 20, 20 on top of 50, 50 on top of 100, and 100 on top of 200, right? That is a first signal that the trend is probably turning upwards. Okay, once we see a sequence like that, that is the start of a possible uptrend. Okay, so what about downtrend? The downtrend is just a mirror image of the uptrend. So you will see that the smaller moving averages, right, will be below. So the 5 will be below, and then followed by 20, 50, 100, 200. So in this case, if it's a downtrend, you will see the 200 moving average on top. The bigger moving average will be on top. So once we see a sequence like that, right, the start of the sequence like that, you indicate that this is the beginning of a downtrend. So in between, once we identify the starting point of the uptrend or downtrend, right, in between you will see that the moving average may start to cross each other, like the second part of the chart here. You can see that the smaller moving averages are starting to cross each other. It doesn't matter, as long as the price, right, doesn't break through the last moving average, which is in this case is the 200 moving average. As long as prices doesn't go above 200 EMA, right, the trend still remains down. Okay, so once again, let me just repeat one more time. Once we identify the sequence, we see a starting sequence of 5 below 20, 20 below 50, 50 below 100, and 100 below 200. That is the starting point of a downtrend. And it will continue to be a downtrend until the candles, okay, the price move above EMA 200, which is the orange line. Okay, I hope I'm clear. But no worry, we'll see a lot of example later on. So in this case, you can see that, oh, it's like pretty obvious that this is a downtrend, right? It's a lower low, lower highs. So it's very obvious it's a downtrend. But not a lot of times the market is like that. Okay, for example, in this case here, you see this chart here. Without any indication, probably it's a bit difficult to identify actually where is this market going. Right, this is a Nasdaq 100 chart, okay, and a 15-minute chart. So without the lines, you probably won't be able to identify actually where is this market going. But if let's say I add in the moving averages, okay, at a glance, we can already have a feel that, oh, looks like this is more bearish. Okay, looks like this is more bearish. Why do I say that? If we see the beginning of the chart on the left, the beginning of the chart on the left, the 5 is below 20, 20 below 50, 50 below 100, and 100 below 200. That is the sequence that that is shown here, indicating that this is the beginning of a downtrend. Okay, beginning of a downtrend. So once we see this, it's probably an indication that it's more bearish, okay, for this market. All right, another example. So same thing, without any indication, it's probably a bit difficult to tell exactly where this trend is. But once I add in the lines, it becomes very obvious, all right, that this is a more bullish today. Right? If you see it on the starting point on the left side, 5 above 20, 20 above 50, and so on, 100, 200. So once we see this sequence, we identify that, oh, from here onwards, it's likely to be more bullish. It's a more bullish trend. Okay, so this is how we use the moving average to identify the trend for the day. And usually for this strategy, right, we'll aim to buy and sell within the day. So we try not to hold position overnight, because the longer we hold the position, the higher the risk it is for us. So for this strategy, usually we try to buy and sell within the same day. Okay, so this one will help us to identify what is the likely sentiment for that day. So okay, another example, probably the last one. If you see something like this, same thing, we can't tell where is the trend. So now if I add in the lines, okay, you see that this is a bit different, a bit difficult to interpret, because we don't see any sequence. You can't see whether, I mean, we don't see the very nice sequence. It seems like the average, the moving average is a mix, pretty mixed, okay, jumble up and down. When we see something like this, right, it's an indication that the market is consolidating, or we call it range trading, sideways. Okay, so once we see this kind of a trend, right, we will not be able to use this strategy to trade. Okay, the strategy that I'm sharing with you today, we need to have a trend. We need to have a very clear trend, whether it's up or down. Okay, if it's a range market, right, then we can't use this strategy to enter. Right, so if it's a range market, we probably have to switch to another strategy. If you have your own strategy to trade the range market, then at least when you see using the moving average, if it tells you that it's a range trading, then you switch to a range trading strategy. Otherwise, if you are using the trend trading, which is what I'm sharing today, right, then once we see this sideways market, then we have to switch another product. Likely this is a range market, so we can't use the strategy to trade. Okay, so it's very important to be able to determine the trend of the market first for all strategy. So we with this moving average, we can determine whether is it more likely to be up, down, or is it a range market. Okay, I hope I'm clear. So the first step is to identify the trend first. Okay, so after we identify the trend, let's say it's an uptrend. Okay, what am I supposed to do? Where am I supposed to buy? Where can I enter? So the next part, we'll be talking about where to enter a trade, right? So this example number 1, if you take a look on the left, the beginning of the chart, on the left side, it started off as a range trading, right? Because you can see the moving averages are not, there's no sequence. It's pretty much mixed up or joined together until probably about 1/4 of the chart, where you see the candle up, spike up, right? And then you start to see a sequence nicely formed: 5, 20, 50, 100, 200. All right, so this is the indication that the uptrend is forming. Okay, this is an indication that it's probably from here onwards, it's going to be an uptrend. Okay, so where do we enter? Of course, on the uptrend, we also don't want to jump in and buy at the high, right? So based on our observation, based on the repeated patterns that we've seen, usually the support level, if it's on an uptrend, we are looking to buy. So the support level is usually at the 100 or the 200 moving average, the blue line or the orange line. Usually these two lines will form the support. Okay, these two lines will form the support. So if you can see the circles that I highlighted in the chart, you can see that prices go up first, and then it retraces back, hits the moving average, rebound, and then second time hits the moving average again and rebound. So you can see that if it's on an uptrend, it always bounces off the 100 or 200 line. Okay, the last two circles, you can see that it bounces off the 100 line. All right, the blue color line. So this is the repeated pattern that we've seen. Okay, so once you identify the trend, we'll look for a price retracement back to the 100 or 200 line, and then we buy. Okay, uptrend, we are looking to buy. All right, so this is the first example. So let's go to the second example. The second example will be more on a downtrend. Okay, more on the downtrend. So same thing, if we look at the beginning of the chart on the left, it started off with also a very, very mixed signal. Okay, most of the moving average are very tightly joined together. There's no sequence. Until the spike down, then you see that the sequence starts to form. If 5 below the 20, 20 below the 50, 50 below the 100, and 100 below 200. So once we see that, this is an indication that the downtrend may be starting. This is the starting point of a downtrend, of a potential downtrend. Okay, and we can see that it has dropped quite a lot. The trend was quite strong. There wasn't much opportunity to enter until the big circle that I circle in the middle. Okay, you can see that it retraces back to the 100 line, the blue color line, and then starts to drop again. Okay, so this is where we want to enter. Okay, once the price retraces back to the 100 or 200 line, this is where we want to go short. Okay, shorting the market. So if it's on a downtrend, we want to short. We want to go short, and if the price comes down, we'll make money. Okay, so this is the Nasdaq 100 chart. So you can see that there are two opportunities here. Okay, first one on the blue line. The second one is when it retraces back to the orange line. Okay, so this is a second example. So right now, probably based on the previous two examples, right? If you see, sometimes the retracement can be at the blue line, sometimes it can be on the orange line. So the next question is, where do I enter? Is it the orange or the blue line? Because between the orange and the blue line, right, can be quite a lot of difference. Okay, for example, in this case, in the Nasdaq, it can be about 100 over points difference, which is quite a lot. So the next question is, how do I determine where do I enter? Is it anytime it hits the 100 line I should try, or only I wait until the 200 line then I try to short? Okay, so earlier on I shared that there is another indicator that we'll be using, which is the RSI. Okay, the RSI. So in this example here, example 3, you will see that if we use the RSI, right, it will help us to determine, even fine tune this strategy to tell us exactly, should I buy, in this case, should I buy on the blue or the orange line, okay, the 100 or the 200 line. So if you see the first two circles, when the price starts to come down and hitting the orange line at the 200 moving average, the RSI is also showing some indication of an oversold. Oversold. Okay, so oversold means price is low. Okay, so to sell too fast, price is low, and it hits the support. This is the best time to buy. Right? So this is the best time to buy. So you can see the first two example, when it hits the orange line, RSI is either near 30 or below 30. Okay, so this is an indication that price is oversold. And the next two example, when you can see that when the price hits the 100 moving average, which is the blue line, okay, it also nears 30, okay, which is also oversold signal, and this is an indication that probably this is the support. All right. So to determine whether which line to use, whether it's the blue line or the orange line to buy or sell, the 100 or 200, we will use the RSI to help us to see whether prices oversold when it hits the 100 moving average. If it's not, then we'll wait for it to hit the 200 moving average before we buy. Okay. So to summarize this this thing here, right? What I meant is, when we see the price coming down to the 100 moving average, we check the RSI. If the RSI is below 30, near 30 or below 30, then it's probably an indication that the 100 EMA will be the support. But if the prices hits 100 EMA and the RSI is still above 30, maybe it's showing only 40 plus, then it's possible that there will be further downside towards the 200 EMA. Then probably I will wait out. So we'll wait for the price to hit the 200 EMA, and then we check the RSI again. If this time the RSI is below 30, then it's probably a good indication, and then we can start to buy when it hits the 200 EMA. Okay, but what if it hits the 200 EMA and RSI is still above 40? Above 30, maybe an indication maybe about 40 or 50. If that's the case, right, I may want to stay out first, because it's not oversold yet and it has already hit the support. So there's the potential that it may break the support. There may be more selling coming in, and when it happens, it may break the support and turn downwards. Okay, so the RSI will help us to determine how high this trade, the probability of this trade. If it hits the support and RSI is below 30, right, then it has a higher probability of working. Otherwise, the chances may not be so high. The probability may not be so high. Okay. So let's see the next example. Okay, I think this is the last example. This is a downtrend. Okay, on a downtrend, what we want to do is we want to short sell. Okay, we want to short sell, and if prices comes down, then we will profit from it. So where to short sell? We will look at the RSI, same thing, but this time we will look at the 70%, because we want prices to be oversold. Prices to be overbought. Prices to be overbought before we come in and sell. So there's no circle here, right? So probably from the chart, you can just take a few minutes and check your and practice on your own to see where do you think the opportunity are. Okay. So normally, when the price hits the 100 or 200 and it's above 70, the probability is higher. The probability of this trade working out is higher. So we need a few things to be in line, then we have a better probability chart, a trade, sorry. Right? Okay, so this is an example. So a quick summary of this strategy. Okay, first step is we need to define the trend. We need to understand what is it doing. Is it going up? Is it coming down? Or is it a range trading? So we do that by using the moving average, and we look for sequence. If the smaller moving average is on top of the bigger one, and there's a very nice sequence, then that is the starting point of an possible uptrend. Okay, if it's the other way around, if the smaller moving average is below, and the sequence is 5, 20, 50, 100, 200 this way, then it will be a downtrend, possible downtrend, and we'll be looking to short. Okay, but if there's no sequence, the 5 next one is 200 followed by 50, 100 and things like that, right? If we can't see a sequence of the moving average nicely, then it's probably a range trading market. In the range trading market, likely we can't use this strategy to trade. Okay, this is a trend following strategy. So we need to see some trend, whether it's uptrend or downtrend, then there's potential trades to be done. Okay, so that's the first step. Second step, after we determine the trend already, we know what we're going to do. Uptrend, we're looking to buy. Downtrend, we're looking to sell. And where to buy, where to sell, this is where we look at the moving average. If it's an uptrend, we'll look to buy at either the 100 or the 200. If it's a downtrend, we'll look to sell either at the 100 or the 200. Okay, and when prices hits the 100 or 200 line, we want to use RSI as a final confirmation. So if we are buying, we are looking for oversold signal. That means if the RSI is below 30. Okay, so once it hits the support 100 or 200, we look at RSI. If RSI is below 30, then I'll buy. Okay, because oversold, temporarily oversold, and price hit support is a good chance to buy. If you are looking to short, we wait for price to go back up above, go back up to 100 and 200, near to 100 or 200, and we look at the RSI. If it's above 70, then we look to sell. Then we will sell. Okay, we look to short, because when price are overbought means price are too high, and it hits the resistance, right? That's where we want to sell. All right, and yeah, and that number 4 is you pull the trigger and do the trade. So a quick summary, this is the 4 steps that we discussed just now. How to do a trade, how to define the trend, and how to enter a trade. Okay. So next up, we'll just go to the MT5 live chart. Okay, I hope you can see my chart. So this is the Nasdaq 100. All right, this is the MT5 platform, and we're looking at the Nasdaq 100 chart right now. So at a glance, we can see before that was probably very range trading, and then since 2 days ago, it started to have form a trend. Okay, when we see that the 5 above 20, 50, 100, 200. Okay, you see a very nice uptrend going up, and right now it's still very, seems like more very bullish, and we'll look to buy when it hits the 100 or 200 line. Okay, 100 or 200 line. Okay, so we'll few ways that we can do this. Okay, we can actually try to queue near the 200 line. Put a queue at the 200 line, which is about 12111, 12111. Okay, around that price, we can try to queue there. Of course, with a stop loss. And on off, if we are able to check the market, we can take a look. If it's near to the 12111 price level, right, then we take a look at the RSI. If the RSI is also nearing 30, okay, then we probably want to just leave the order on. But if let's say we check, and when it's near to the level that we want to enter, and we see the RSI is still pretty high, maybe 50 or above, then probably we want to wait and cancel the order first, and then we see how it goes. Okay, see how it goes. So usually this is what we'll do. So we can just look at the chart and we analyze and say, okay, probably this is an uptrend. So this is what I would like to do today. So looking to buy, and it's either the 100 or the 200 line. Okay, so this is the Nasdaq 100. Right. Okay, another thing probably I would like to share with you right now, just a quick sharing additional information. One good thing about this strategy, right, is there is also an indication that the trade is wrong. Okay, we can know that the trade is wrong somehow. Okay, let me just show you an example. Okay, so let's see if I can show you any example. Okay, probably we can take a look at this example. Okay, it's on an uptrend. Okay, you can see that here it begins, the uptrend begins, and very nicely you have some opportunities to take. Okay, and then the final opportunity, you can see that, oh, it comes down, hits the 200 line, and then starts to rebound. So probably, let's say I took a trade, I bought at about 120.99. Okay, and then we moving forward, suddenly you see that price starts to go below. Price starts to go below the 200 moving average. Actually, this is already an indication that the trade is turning sour. Okay, it's a wrong trade. Because most of the time, if it's a correct trade, right, it shouldn't break below the last support for so long. Okay, this is a 15 minutes chart. So every candle is actually 15 minutes. Okay, so you can see that here, once it stays below and it doesn't go back above, sometimes there's a forced breakdown and then reverse, then it's fine. But if it stays below for very long and you can see that it's not going back up, okay, then probably instead of waiting for it to hit your stop loss, you just close the position, take a small loss and just close the position. Okay, so yeah, you can see that it's pretty volatile the previous few days. Okay, and then it starts to move a bit rangy. Okay, not very clear uptrend. Okay, here will probably start a bit uptrend, and you can see some opportunity, but still quite spiky. As you can see that there's a lot of false breaks. Okay, here really is very range trading, right? And very volatile, you can see for the past few days. So a lot of range trading, which we won't be able to do any trades. Okay, until right now, this is the current price. The trend is smoother, if you can see. Okay, compared to previous time, where the moving averages are pretty close to each other. There's not much real trend. This is a very nice trend. Okay, opening up. Okay, so wait for price to come back now to the EMA 100 or 200. Check the RSI, and then if there's a trade, we will go and enter. You enter the trade. Okay, so let's see. Okay, let me go back to the slides and see if there's anything else. Okay, so just a quick live chart analysis from the live prices just now. The example that we saw was from the Nasdaq 100. There are other products inside that we can trade. Okay, so let me just go back. Okay, let me show you. For example, we have the S&P 500 as well. Okay, S&P 500 looks like also on the uptrend, but not very sure, because let's see whether when the price hits the EMA 200, is RSI going to be oversold? Okay, RSI right now for the S&P is only at 44. It's still quite far away from 30. So if let's say today, if the price comes down to the EMA 200 and the RSI is still not below 30, right? You may want to just wait out and see whether does it rebound. If it does rebound, maybe you can jump in. Okay, jump in to buy. All right, so this is the S&P. Dow Jones not so strong. Okay, of course, obviously we compare the three in US index. Seems like technology stocks is still quite bullish, right? The Nasdaq you can see is pretty strong. S&P a bit more on the financial side. Okay, still doing well, but the industrial side may be not so strong. Okay, you can see that it's already broken below the EMA 200. All right, but let's not confuse ourselves. So normally how I trade is I will just focus on one product, look at the chart, and then we trade based on that chart. Okay, sometimes if it has too much information, you may get confused as well. So we just focus on the chart and trade it. If it's wrong, then of course we just cut loss. Okay, because this strategy will allow us to cut loss faster also. If let's say there's indication that it's a wrong trade, we can cut loss faster. All right, so let me go back to my slides. Okay, so let me just quickly share with you the advantage of trading with MT5, MetaTrader 5. You can see that this, if you have been trading for Forex, right, currency trading, you'll be probably familiar with the MetaTrader 4. MetaTrader 4 has been in the market for very, very long and is an award-winning platform. So MetaTrader 5 is the latest platform from the same group, okay, from the MetaTrader MetaQuotes group. Excuse me. Any product that you see in this platform with Phillip, it's zero commission. So there's no commission in this platform. So whatever you trade is zero commission. And the assets that we provide from FX, CFD will include index, commodities, gold. We have crypto as well, and shares, individual shares. We have a Singapore shares, Hong Kong shares, as well as US shares. Okay, so you can trade individual counters as well. And advantage is that you can trade micro lots. Okay, you don't have to do a big contract. You can trade. You can go down to micro lots. So if let's say you are very new to leverage trading, or you're new to CFDs or any of the products there, you may want to start small to learn to start learning about it. Okay, and also if you trade with Phillip, we provide free auto chartist and trading central tools. Okay, these tools are we paid for the services, and actually our client can download these tools for free and use it in the MetaTrader platform. So what are these two? The auto chartist is actually something like a scanner. Okay, if you have been trading stocks, you may know that there's such thing as a stock scanner. So the auto chartist is something like a scanner. It will scan for trading patterns and on all the products that you put on your watch list. So once they scan something and see that it fits certain of their trading formula and there's opportunity, it will let you know. You can check, you can see the patterns, and then you can decide whether you want to take the trade or not. So this is like a scanner. And Trading Central is more of AI tools. That means it has its own formula embedded. Once you put this Trading Central software into the MT5, right, it will tell you what is its view based on the trading formula that it has. So it probably tell you that it's going up and where is the target price, or it's coming down and where is the target price, things like that. Okay, so all these are free for clients, right? Free for our Phillip Futures clients. And if you like to try the demo, right, you can scan the QR code here. Okay, free demo. So just scan and download the platform and you can start trading. It's live price. You can probably play around with it and test your own trading strategy. And if you are comfortable, then you can open an account with us. Okay. And talking about opening an account, right now you can actually scan the QR code, fill up the form, and within an hour, right, you can fund the account and start trading already. Okay, so it's so fast. Once you fill in the form, everything is okay. If there's nothing else to follow up with you, you will get your account number, fund the account, you get a password, everything, and then you can start trading within an hour. Okay, so if you want to take any opportunity, okay, you think that there's some opportunity right now and you want to open fast, you want to have an account to start trading fast, okay, you can just try out this online account opening and open an account with us. Okay, so back to coming to the end of my session, right? This is just to go back to our earlier discussion at the beginning where we discussed about IQ and EQ. Some of you who have attended my session before probably already know the answer. Okay, so just to talk back, just to come back to this topic about trading psychology. We know that in trading, of course, we need IQ. Why? Because we need to be able to understand concept quickly, process the information, make analysis, and to be able to create a trading strategy for ourselves. So all these require a good knowledge, good IQ, to be able to analyze and to process information and to learn quickly, right? So we definitely need IQ. And we know that trading is not only about how smart we are or how good we are at creating strategy. Okay, because implementing and executing the strategy takes very high discipline, or we call it very good self-control on our emotions. So EQ, how does EQ come into trading? In trading, right, there's this, we all know that there's greed and fear. And fear is a very scary thing when it comes to trading. Okay, usually when we experience fear, most of the time we don't know what to do. Okay, we get lost and we probably just hang there and we don't know what to do. Okay, we are stunned. So it's important to understand our pain threshold. Okay, in trading, right, of course, it's not every time we make money 100%. There will be losing trades. Definitely, there will be losing trades. There will be losing streaks. Okay, there will be a period of time that we keep losing, but we must be able to make sure that these losses, right, doesn't wipe up the whole account. Okay, to be able to do that, we must understand our trade pain threshold. Because if you have been trading before and for a long time, probably you will experience this. You put on a trade, and when there are some small losses, oh, you're still in control. You said, okay, loss, I can cut, right? No problem. Just maybe I have, for example, let's say I have 10,000 in my account. I'm losing $50 to $100. Okay, I know. Okay, it's a wrong trade. I can cut. But if, let's say I put in a trade and then I didn't take a look at it. After a while, I come back and realize that, oh my goodness, it has already lost about $1,000, $2,000. Okay, I already lost $1,000, $2,000. And that moment on, right, most of the time, most of us, right, will not be able to cut the loss. Why? Because it's out of our average losses already, and the pain is too much. Okay, within a few hours, we lost 2,000, 20% of our portfolio. That is very, very harsh. Okay, so a lot of times we are not able to accept it, and then what happens is we'll keep hoping, or worse, we just average and try that, hope that it will reverse. Okay, so when we talk about EQ in trading, right, what we want to do is we want to know where is our pain threshold, how much losses onwards, then we start to be out of control. Okay, we start to be out of control. There's that when we lose money, right? Definitely there's pain, but there's different levels of pain. If the pain is too much that we can't cut, we can't cut loss, that is already over the threshold already. So we must understand, if we can find out, if we, once we trade more, right, we will know that how much losses will be out of control, okay. So once we understand this, we want to really manage our risk. We have to always have a discipline to put a stop loss that is not more than the pain threshold that I can take. Okay. So this is where the EQ part comes in. Understanding where is our pain threshold. Okay. But other than that, there is this part that another part of the psychology that is very important. Okay, very important for people who wants to really become full-time trader. Okay, who wants to trade full-time, which is the AQ. Okay. Some of you may have heard of this before. AQ stands for adversity quotient. It is how we handle failure, how we handle adversity. Okay. In trading, there will be times where no matter what you do, it seems like wrong. Okay. For example, you enter a trade and then you make money. Wow, you make $100, you take profit. Okay, happy. But the next moment after you take profit, the price move higher, so much higher, 10 times higher, and then you could potentially make 1,000, but you only make 100. So what happens? You get angry. So when we get angry, what happens? We probably will be doing a lot of revenge trade. Okay, you're doing a lot of revenge trade. So you make $100, and then suddenly you see the market move up. Wow, you could potentially have made $300, but you only make 100. And then the next thing we think that it's too high, I'm going to short it. Okay, because the pain of losing out. Okay, so we do the opposite. We missed the chance to hold on higher, so we short it. But what happens is if the market is that strong, most of the time when we do that, right, we are losing money, and we may lose more than $100 profit that we make. So AQ is how fast we can accept that this failure or this non-perfect trade and move on, and help us to move on and see what is the next best thing to do. Okay, and stabilize our emotion and see what's the next best thing to do. Okay, because a lot of times, actually, like back to the example, I made $100 profit, I took it and move up higher. If we are calm enough to analyze, right, probably we'll realize that this is a real uptrend, So what we do is we can buy again. Okay, we can buy again and then follow the trend again. But a lot of times, it's the opposite. We think that's too high, so we short. Okay, and then we lose money. Okay, same goes for losses. So it comes down, we cut loss. And the most painful part is when we cut loss, the market rebounds. Okay, that's the most painful part. Always, it's coming down, I cut. After I cut, straight away the market rebound and then back to the level. So in the first place, if I didn't cut, I shouldn't have lost, right? But in trading, right, we have to understand that it will happen. Such thing will definitely happen. Okay, we cannot escape it. Okay, we cannot escape it. It's not, the market is not against us, it's not against you, it's not against me. It's just that everybody will experience something like that once in a while, or maybe quite frequent, I would say. Okay. So with a strong AQ, right, AQ help us to accept the fact, okay, I've cut loss, market rebound. Okay, let's accept it. Okay, accept it, accept this failure, accept this not really a failure, but accept this imperfect trade, and then we move on calmly from there. Okay, this is a very important habit to have for professional traders if you want to really trade. Otherwise, you can see that first thing, you may be a very frustrated person, okay, because every day you'll be facing the same thing. Okay, second thing, you may blow your account very fast, okay, because of all the revenge trades. So with a strong AQ to help us to accept the fact, to have the right mindset, it will help us to be more consistent in our trading. Okay, so hopefully this sharing is useful. Okay, so just let me see what else I have. Okay, that will be the end of my session. So I thank you for your attention, And if let's say you would like to try out our platform, the MT5 platform, you can scan the demo account to try it out. Or if let's say you're ready to start, okay, and you want to trade right now, you can scan the live account, a QR code, and your account will be ready within an hour. You can fund it and you can trade. Okay, so hope that the session is useful to you. Okay, I do see that there are some questions right here. Let me see if I can answer some of them. Okay, do MT5 provide index options for hedging purpose? Okay, MT5 doesn't have index options, but we do have a hedging facility. That means you can do long and short at the same time. Okay, hedging facility, so you can do long and short at the same time. Okay, let me see what else can I answer. Can I trade US shares on MT5? Yes, you can. We offer some US the more popular US shares on MT5. So you can download the platform, apply for our a demo account or live account, and you'll be able to see the prices of the US shares. Okay. Okay. All right. I think I will stop here. If there are some questions, of course, asked by the audience, what I'll do is I'll look through the questions and I will probably email the answer back to you. Okay. If you have any questions, okay, do feel free to contact us. I'm sorry, I think I forgot to put my contact number. Let me just quickly type it out for you. Okay. Okay, let me just quickly type it out for you. Okay, my name is Simon Teo, and my contact will be 6576-9828. This is my direct line. Okay, and my email is tops@phillip.com.sg. Okay, yeah. So sorry about it. I missed out the contact details. So hopefully you can see this right now. So if you have any questions, feel free to contact me or email me, and then we can bring the discussion on from there. Otherwise, that will be all for me today. I thank you once again for your attention, and hopefully the session has been useful to you. Okay, thank you everyone, and have a good night.